Before we begin, a quick and important disclaimer. The following content is provided strictly for educational and entertainment purposes. It explores historical data, sociological trends, and economic theories related to marriage and divorce rates in the United States. This video does not constitute legal, financial, or psychological advice. Marriage and divorce involve complex legal proceedings and significant financial implications that vary by jurisdiction. Viewers are strongly encouraged to conduct their own due diligence and consult with qualified professionals, such as family law attorneys, certified financial planners, or licensed therapists, before making any decisions regarding their personal or financial lives. The conventional wisdom suggests that when a marriage is under pressure, a financial catastrophe should be the final straw that breaks the camel's back. We have all heard the statistics. Money is cited as one of the leading causes of marital friction in the United States. So logically, when the stock market plunges, when unemployment lines stretch around city blocks, and when the value of the family home evaporates overnight, we should expect to see a massive surge in divorce filings. But history tells a story that is not only different but deeply counterintuitive. During the most crushing economic periods in American history, from the breadlines of the 1930s to the foreclosure crisis of 2008, the divorce rate did not skyrocket. In fact, it plummeted. Imagine it is 2009. The Great Recession is in full swing. You and your spouse have watched your retirement accounts lose 40% of their value. You are underwater on your mortgage, meaning you owe more to the bank than the house is actually worth. The tension in the house is palpable. The arguments over the grocery budget or the heating bill are relentless. By all accounts, the marriage is over. But then you look at the logistics. To get divorced, you need 2 security deposits for 2 new apartments. You need to pay 2 utility bills. You need to hire 2 lawyers. And perhaps most daunting of all, you need to figure out how to sell a house that no one wants to buy, or worse, how to split a debt that neither of you can afford to pay alone. In this moment, the economic reality of the United States creates what sociologists call a marital anchor. You aren't staying together because the romance has returned. You are staying together because you literally cannot afford to leave. This brings us to the Great Divorce Paradox. In a thriving economy, divorce is often a matter of personal fulfillment and individual liberty. In a failing economy, divorce becomes a luxury good. This video is a deep dive masterclass into the hidden mechanics of the American household during times of crisis. We are going to look at why the divorce rate reached a historic low during the Great Depression, only to explode during the post-war prosperity of the 50s and 60s. We will analyze the specific data points from the 2008 financial crisis that show how negative equity in housing acted as a more effective form of marriage counseling than any professional therapist ever could. For the modern American audience, understanding these historical trends is more than just a history lesson. It is a fundamental look at how your personal life is tethered to the macroeconomy. Today, as we face talk of inflation, fluctuating interest rates, and a shifting labor market, many couples find themselves asking if their relationship can survive the next downturn. By examining the potential outcomes and case studies from the past century, we can solve the problem of uncertainty. We can identify the warning signs of how economic stress manifests in a marriage, and more importantly, understand the financial barriers that might trap individuals in unhappy situations, or, conversely, provide the stability needed to weather a temporary storm. We are going to deconstruct the cost of separation, and look at how the shift from a manufacturing economy to a service economy changed the way men and women view the utility of their partners during a recession. To understand where we are going, we have to understand the economic theory of marriage, famously pioneered by Nobel laureate Gary Becker. Becker treated the family as a small factory that produces goods and services like meals, shelter, and child-rearing. In this model, people get married when the output of the couple is greater than the sum of what they could produce individually. But when a recession hits, the production costs of maintaining that family factory change. We will explore how the specialization of roles in the 1930s made it nearly impossible for a single woman to survive outside of a marriage, effectively forcing the divorce rate down through sheer necessity. Contrast that with the modern era, where dual-income households face a different set of risks. We will look at step-by-step details of how the loss of a second income can either catalyze a split or, surprisingly, create a new type of forced cooperation that keeps the family unit intact for years longer than expected. We are also going to tackle the darker side of these historical trends. When the official divorce rate drops during a recession, it doesn't always mean that marriages are healthier. During the 1930s, poor man's divorce became a national epidemic. This wasn't a legal filing in a courthouse, it was desertion. We will look at the case studies of thousands of men who simply walked away from their families because they could not bear the shame of being unable to provide, leaving their wives and children in a legal and financial limbo that lasted for decades. This historical context is vital for understanding the hidden statistics of domestic stability. By the end of this deep dive, you will understand the intricate relationship between the Federal Reserve's interest rates and the likelihood of a couple in suburbia filing for a no-fault divorce. You will see how the introduction of the legal framework for no-fault divorce in the late 1960s and 70s collided with the stagflation of that era to create a perfect storm of social change. We will examine why the silver divorce trend, older couples splitting after decades of marriage, behaves so differently during a recession compared to younger couples just starting their lives. This is a journey through the heart of the American dream, and what happens to that dream when the money runs out. We are looking at the potential outcomes of economic pressure, the historical trends of household debt, and the fascinating way that humans prioritize their needs when faced with scarcity. If you have ever wondered why some marriages seem to thrive under pressure, while others crumble at the first sign of a stock market dip, the answers are buried in the data of the last 100 years of American economic history. We are going to peel back the layers of the 1929 crash, the 1970s oil crisis, the 1980s farm crisis, and the 2008 housing collapse to show you exactly how the American family adapts, survives, or dissolves when the chips are down. This is the history of the United States, told through the lens of the most intimate contract two people can sign. Let us begin the investigation into the true cost of "till death do us part" in an unstable economy. To truly grasp why the American family unit reacts so violently to economic shifts, we have to travel back to the most devastating financial collapse in modern history, the Great Depression. Imagine it is 1932. The national unemployment rate has surged to a staggering 25%. In cities like Chicago or Detroit, that number is closer to 50%. Now imagine a couple named Arthur and Martha living in a small apartment in Pennsylvania. Before the crash of 1929, Arthur worked as a foreman at a local mill, and Martha managed the household. Their marriage was already strained by the usual frictions of the era, but the sudden evaporation of their life savings and Arthur's subsequent layoff changed the calculus of their relationship overnight. In a modern 2026 context, we might expect Arthur and Martha to separate under this immense pressure. However, historical trends from this era show the exact opposite. Between 1929 and 1933, the United States divorce rate plummeted by nearly 25%. This was not because the Great Depression magically healed broken hearts or brought families closer together through shared hardship. It was because the legal and social cost of exiting a marriage became an insurmountable barrier for the average American. Let us break down the step-by-step details of the financial barrier to divorce in the early 1930s. First, there was the legal fee. In an era where a loaf of bread cost 7 cents and the average weekly wage for those lucky enough to have a job was less than $20, hiring a lawyer for a divorce proceeding was a massive capital investment. A standard, uncontested divorce could cost anywhere from $50 to $100 in court and legal fees. For Arthur and Martha, that represented months of grocery money. Without a steady income, the idea of paying a professional to facilitate a legal separation was functionally impossible. Second, we must consider the loss of the economy of scale. When Arthur and Martha lived together, they shared one rent payment, one heating bill, and one set of kitchen supplies. If they separated, their cost of living would essentially double while their total income remained at zero. In 2026, we see a similar potential outcome when young couples choose to cohabitate longer than they might otherwise want to, simply because the cost of a one-bedroom apartment in a major U.S. city has outpaced median wage growth. In 1932, this was not just a trend, it was a survival strategy. But the most fascinating and perhaps tragic aspect of this era was the rise of what sociologists call the poor man's divorce. Because the legal system was gated behind a paywall, thousands of men chose a different path: desertion. Imagine Arthur waking up one morning, looking at his empty cupboards and his distraught wife, and simply walking out the door. He does not file for divorce. He does not seek a legal separation. He just hops on a freight train and disappears into the vast landscape of the American West, hoping to find work and perhaps start over where no one knows his name or his failures. By 1940, it was estimated that over 1.5 million married women in the United States were living apart from their husbands without being legally divorced. These women were stuck in a legal gray area. They could not remarry, they often could not claim state aid because they were technically still married, and they had no way to track down their husbands for child support. This hidden statistic proves that the lower divorce rates of the 1930s were a mirage. The marriages were failing at record numbers, but the official records could not capture the reality of abandonment. As we move further into the decade, we see another shift. Historical trends indicate that as the New Deal programs began to provide a minimal safety net, the divorce rate started to creep back up. This brings us to a critical realization about the American economy. Divorce is a procyclical indicator. It moves in the same direction as the economy. When the GDP goes up, divorce goes up. When the GDP goes down, divorce goes down. This is because a thriving economy provides the liquidity necessary for individuals to act on their personal desires. Consider the case study of the late 1930s recovery. As manufacturing picked up in preparation for the war effort, men like Arthur found work again. With a steady paycheck, the first thing many of these men and women did was finally pay the lawyer they couldn't afford 5 years earlier. There was a massive backlog of failed marriages that were finally processed once the financial friction was removed. This suggests that recessions do not necessarily save marriages, they merely delay the inevitable. Now, let us look at the sociological pressure of the era. In 1932, a woman's ability to survive outside of a marriage was drastically lower than it is in 2026. Occupational segregation meant that most high-paying jobs were reserved for men. If Martha left Arthur, she likely faced a life of extreme poverty or a return to her parents' home, which was likely already overcrowded with other relatives fleeing the crisis. This era saw the rise of the multi-generational household not out of cultural preference, but out of absolute necessity. Step by step, the economic collapse of the 1930s forced a return to traditional roles that many had begun to question during the Roaring Twenties. The independence of the flapper era was replaced by the grim reality of the breadline. This created a paradoxical stability. Couples stayed together because they were scared of what was outside the front door more than they were frustrated with what was inside it. However, we cannot ignore the psychological toll of this forced togetherness. Historical case studies from the Works Progress Administration's interviews with families during the era reveal a profound sense of trappedness. One woman in Ohio described her marriage during the recession as a Cold War, where she and her husband stopped speaking for 2 years, but continued to share the same bed because they only had one blanket between them. This is the reality behind the low divorce statistics of the Great Depression. It was a period of high marital distress but low marital dissolution. This brings us to a modern comparison. In 2026 we have different mechanisms, but the underlying pressure remains the same. While we have no-fault divorce laws now, which didn't exist in the 1930s, we have a new barrier: the complexity of the dual income trap. In the 1930s, the husband was the primary breadwinner. In 2026, most American households require 2 incomes to maintain a middle-class lifestyle. When a recession hits today, the fear isn't just about paying the lawyer. It is about the fact that neither partner can qualify for a mortgage or even a rental lease on a single income. As we look at the data, a pattern emerges that we will see repeated in every major U.S. recession. The initial shock of the recession causes a freeze. People hunker down. They prioritize the essentials. They stay in unhappy situations because the risk of the unknown is too high. But what happens when the pressure cooker finally reaches its limit? What happens when the economy starts to thaw, but the social fabric has been permanently altered by the years of strain? The Great Depression set the stage for a massive explosion in divorce rates that wouldn't fully materialize until after World War II. But the seeds were sown in those cold, penniless years of the early 30s. We are going to look at how the transition from the necessity marriage of the 1930s to the companionate marriage of the 1950s created a new set of economic vulnerabilities that would eventually lead to the highest divorce rates in American history. But before we get to the post-war boom, we have to look at the specific way the U.S. government tried to intervene in the family unit during times of crisis. Was the promotion of family values during the recession a genuine social movement? Or was it a calculated economic policy designed to reduce the burden on the state? And more importantly, what happens when a recession hits a society that has already normalized divorce? To answer that, we have to look at the forgotten recession of the late 1940s, and the surprising way it paved the road for the most iconic decade in American family history. What if I told you that the legendary stability of the 1950s was actually a fragile bubble, waiting for the right economic needle to pop it? We are about to uncover how a shift in the American housing market changed the way we divorce forever. To understand why the 1950s were seen as a golden age of marital stability, we must look past the black and white television shows and into the ledger books of the average American household. The post-war era introduced a new economic character to the United States: the suburban homeowner. Before World War II, most Americans were renters. By the mid-1950s, thanks to the GI Bill and the explosion of the Federal Housing Administration, millions of families were locked into 30-year fixed-rate mortgages. This shifted the marital dynamic from one of shared survival in the 1930s to one of shared asset accumulation. Imagine a couple named Frank and Betty in 1954. Frank is a veteran working at a manufacturing plant in Ohio. Betty is a homemaker raising 3 children in a brand-new tract home. On the surface, their life is the American dream. But the recession of 1953 to 1954, though brief, sent a shockwave through their community. Frank's overtime pay disappeared, and for 3 months, the specter of layoff loomed over the dinner table. In the 1930s, Arthur might have deserted his family to spare them the shame of his failure. In 1954, Frank cannot just walk away. He is tied to a mortgage, a car loan, and a credit account at the local department store. Historical trends from this period suggest that the suburban house acted as a physical and financial cage that suppressed the divorce rate. To get a divorce in 1954, you didn't just need a lawyer. You needed a way to unwind a complex web of government-backed debt. If Frank and Betty split, who gets the VA loan? Who keeps the equity in a house that is only 3 years old? In most cases, the answer was no one. The house would have to be sold, the debt settled, and both would be forced back into the rental market at a time when apartment vacancies were at historic lows. This created a potential outcome where staying in a miserable marriage was the only way to maintain a middle-class identity. The step-by-step details of the mid-century divorce process were also a massive financial deterrent. In the 1950s, the United States did not have no-fault divorce. To end a marriage, one party had to prove fault: adultery, cruelty, or abandonment. This required private investigators, witness testimonies, and public airings of private grievances. The cost of such a legal battle, especially during a recessionary dip like 1958, was astronomical. For Frank and Betty, a divorce would cost more than a new Chevrolet. Consequently, the divorce rate remained artificially low, not because people were happier, but because the economic and legal barriers were designed to be insurmountable for the average wage earner. We can see a fascinating parallel here to our current year of 2026. Today, many American couples find themselves in what economists call a golden handcuff situation. If a couple bought a home in 2021 with a 3% mortgage rate, and they are facing a marital crisis in 2026 where mortgage rates are significantly higher, the cost of moving out becomes a dominant factor in their decision-making. Just like Frank and Betty in 1954, the modern couple realizes that if they divorce and sell the house, neither of them will be able to afford to buy a new property at current market rates. The asset itself becomes the primary reason for the continuation of the domestic union. As we move into the 1960s, the economic landscape began to shift, and with it, the stability of the American family. We often credit the Cultural Revolution for the spike in divorce rates, but the underlying driver was a massive change in the American labor market. During the brief but sharp recessions of 1960 and 1961, we began to see the first signs of the service economy taking hold. Women were entering the workforce in record numbers, not just out of a desire for liberation, but because the rising cost of living required a second income. Imagine a new couple, Gary and Susan, living in 1969. Unlike Betty, Susan has a job as a legal secretary. When the recession of 1969 to 1970 hits, Gary is laid off from his middle management job. In previous decades, this would have been a catastrophe that forced Susan to cling closer to the marriage for protection. But in 1969, Susan's paycheck provides a safety net. For the first time in American history, a significant portion of women had the financial liquidity to imagine a life outside of marriage. This leads us to the most significant legal economic shift in U.S. history: the arrival of no-fault divorce laws, starting with California in 1969. Suddenly, the economic barrier of proving fault vanished. But there is a catch that most history books overlook. The legalization of no-fault divorce coincided almost perfectly with the era of stagflation in the 1970s. This was a period of high inflation and stagnant economic growth. You would think that high inflation would make divorce more expensive and thus less common, right? The data shows the opposite. During the 1973 to 1975 recession, one of the deepest since the Great Depression, the divorce rate in the United States reached an all-time high. Why? Because the economic utility of the marriage had changed. In a world of 10% inflation, a single income could no longer support a household. If Gary and Susan were unhappy, the recession didn't trap them together. It acted as the final proof that their partnership was no longer providing the economic security it promised. Susan looked at her stagnant wages and Gary's lack of prospects and realized that she might be better off on her own, or perhaps with a different partner who had better earning potential. Case studies from the mid-70s reveal a shift in American psychology. The Me decade wasn't just about self-actualization. It was about the realization that in an unstable economy, the only person you can truly rely on is yourself. The traditional contract of the 1950s, where the man provided security and the woman provided domesticity, crumbled under the weight of 1970s price hikes at the gas pump. When the cost of milk and gasoline doubled, the specialization model of marriage that Gary Becker wrote about became a liability. But here is where the story takes a turn that still affects us in 2026. While divorce rates spiked in the 70s, they hit a plateau and then began a long, slow decline that has continued for decades. Most people think this is because people are getting better at marriage. The reality is far more complex and deeply tied to the widening wealth gap in the United States. We are seeing a trend where divorce is becoming a class-based luxury. In 2026, the wealthiest 10% of Americans have divorce rates that mirror the stable 1950s, while the bottom 50% face marital dissolution rates that are higher than ever. Why does a recession affect a wealthy couple in Connecticut differently than a working-class couple in Arizona? To understand that, we have to look at the role of the 401k, the rise of the gig economy, and how the 1980s farm crisis created a blueprint for the modern economic collapse of the American heartland. Step by step, we are going to analyze how the Reagan-era recessions changed the way we value marital assets. We will look at how the shift from pensions to private investment accounts made divorce a high-stakes gambling match. If the stock market crashes right as you are filing for divorce, who bears the loss of the retirement fund? What happens when the court orders a house to be sold in a market where there are no buyers? We are about to dive into the 1980s, an era of corporate raids, farm foreclosures, and the birth of the prenuptial agreement as a standard tool for the American middle class. The decade of greed changed the marriage contract from a sacred vow into a corporate merger, and the recessions of that era were the audits that no one saw coming. Did the 1980s recessions actually make us more likely to stay together? Or did they just teach us how to hide the cracks in the foundation for the sake of the portfolio? The answer lies in a forgotten crisis that decimated the American Midwest. And it's a story that every couple in 2026 needs to hear before the next downturn hits. The early 1980s in the United States marked a period of profound economic restructuring that fundamentally altered the landscape of American marriage. While the 1970s were characterized by a cultural explosion of divorce, the 1980s introduced a new, colder reality: the era of high interest rates and the death of the industrial heartland. To understand how a recession impacts the decision to stay or go in 2026, we have to examine the Volcker shock of 1980 and 1981. Federal Reserve Chairman Paul Volcker raised interest rates to unprecedented levels, peaking at 20%, in a desperate and successful attempt to break the back of inflation. For the American family, this meant that the cost of debt became a crushing weight that dictated every aspect of domestic life. Imagine a couple named David and Linda living in a rural community in Nebraska in 1982. David is a third-generation farmer who took out a massive loan in the late 1970s to modernize his equipment and expand his acreage, a common move encouraged by the government at the time. Linda manages the farm's books and works part-time at a local clinic. When the recession hits and interest rates skyrocket, the value of their land, the primary asset of their marriage, plummets. Simultaneously, the interest payments on their debt become more than the farm produces in profit. This was the start of the farm crisis, a localized but devastating recession that saw thousands of families lose everything. In this historical trend, we see a divergence from the national divorce statistics. While the national rate began to stabilize, rural divorce rates in the Midwest saw a unique and painful spike. However, the step-by-step details of these divorces were unlike those of the suburban 1950s. For David and Linda, a divorce in 1982 wasn't just a social separation. It was a liquidation. Because their debt was tied to the marriage, neither could leave without triggering a total financial collapse. Case studies from this era show that many couples entered a state of economic cohabitation. They were legally married and lived in the same house because the bank owned the house, and they were essentially working for the bank until the foreclosure was complete. The recession didn't just delay their divorce. It turned their home into a shared workplace for two people who could no longer stand to be in the same room. As we look at the urban and suburban sectors during the 1980 to 1982 double-dip recession, a different economic force was at play: the invention of the 401k. Before 1978, most workers had defined benefit pensions. If you divorced, the pension was a steady stream of future income that was relatively easy for a court to value and split. But the 1980s saw the rapid rise of defined contribution plans. This shifted the risk of the market from the employer to the individual. In 2026, we take this for granted, but for a couple divorcing during the 1987 stock market crash, this was a nightmare. Consider the potential outcomes of a divorce filing in October 1987. If a couple had a retirement account worth $500,000 on October 1st, and they reached a settlement agreement on October 20th, Black Monday, that account might have lost 25% of its value in a single afternoon. Who bears that loss? This uncertainty created a massive chilling effect on divorce filings during market volatility. The historical data shows that whenever the Dow Jones Industrial Average experienced a significant correction, the rate of new divorce filings in high-wealth counties in the United States saw a correlated dip. People were waiting for their portfolios to recover before they were willing to sign a settlement. This leads us to a pivotal legal shift in the 1980s that changed the price of liberty: the valuation of professional degrees and licenses as marital property. A landmark case from 1985, O'Brien v. O'Brien, established that if one spouse supported the other through medical or law school, the value of that degree was an asset that could be split in a divorce. During the 1980s recessions, when physical assets like houses and farms were losing value, these intangible assets became the new battleground. Imagine if a modern couple in 2026, Michael and Sarah, are facing a similar situation. Sarah worked 2 jobs to put Michael through a high-level data science program. Now, in a tech sector recession, Michael has a high-value degree but a stagnant salary. If they divorce today, a court in many U.S. jurisdictions will look at the projected lifetime earnings that the degree provides and award Sarah a portion of that future value. This creates a massive financial liability for the degree holder. In a recession where cash flow is tight, the prospect of paying out a percentage of future earnings can make divorce financially ruinous. The 1980s also birthed the mainstreaming of the prenuptial agreement. Before this decade, prenups were largely for the ultra-wealthy or Hollywood stars. But the recessions of the early 80s taught the rising class of yuppies, young urban professionals, that marriage was a high-stakes economic merger. They saw their parents' assets wiped out by inflation and high-interest debt, and they wanted a firewall. By 1985, the use of prenups among middle-class Americans began to climb. This was a defensive move against the potential outcomes of economic instability. It shifted the philosophy of marriage from a permanent bond to a contract with an exit strategy already priced in. We must also look at the rise of the dual-income household during this decade. In the 1930s, the loss of the husband's job was a death knell for the household. In the 1980s, the recession forced a permanent change where both spouses had to work just to maintain the same standard of living their parents had on one income. This created the two-income trap. When both people are working, they tend to bid up the price of housing in good school districts. This means they are carrying maximum debt based on 2 salaries. If the 1982 recession caused one person to lose their job, the household didn't just feel the pinch. It faced immediate insolvency. Case studies of families in the Rust Belt, cities like Pittsburgh, Gary, and Youngstown, reveal that during the industrial collapse of the early 80s, the divorce rate actually stayed lower than the national average. This wasn't due to cultural conservatism alone. It was the lack of an exit ramp. When the steel mills closed, the entire community's equity vanished. You couldn't sell your house because no one was moving into a town with no jobs. You couldn't move away to start a new life because you were underwater on your mortgage. The recession acted as a giant net, pinning people to a geography and a relationship that they could no longer afford to leave. What we are seeing is that the American recession is a great filter. It separates those who have the liquidity to afford their freedom from those who are forced into a survival-based union. In 2026, as we look at the potential for a new downturn, the lessons of the 1980s are more relevant than ever. We have higher levels of household debt, more volatile retirement accounts, and a legal system that increasingly views human potential as a splittable asset. But the 1980s were just the beginning of the financialization of the American heart. As we moved into the 1990s and the early 2000s, a new bubble was forming, one that made the farm crisis look like a minor correction. We are talking about the housing bubble. And when that bubble burst in 2008, it didn't just destroy banks. It fundamentally changed how Americans think about the cost of a spouse. How did a sudden drop in home values across the entire country create a generation of divorce-stalled couples? And why did the divorce rate in the United States hit a 40-year low exactly when the economy was at its worst? To understand the modern American marriage, we have to look at the wreckage of the 2008 financial crisis and the strange, unintended consequences of the foreclosure moratoriums. The next part of our masterclass will reveal how the greatest real estate crash in history became the ultimate test of the marital bond, creating a phenomenon that sociologists are still trying to unravel today. What happens to a marriage when the house is worth zero, but the debt is forever? The answer is a haunting look into the future of the 2026 economy. The year 2008 arrived like a wrecking ball to the American household, but not in the way most social scientists expected. We are entering the era of the Great Recession, a period defined by the total collapse of the U.S. housing market. To understand the divorce trends of this era, we have to look at the primary asset of the American middle class: the home. For decades, the family home was treated like a high-interest savings account or an ATM. People took out home equity lines of credit to fund lifestyle choices, vacations, and even the legal fees for their first divorces. But when the subprime mortgage crisis hit, that ATM didn't just stop dispensing cash. It started demanding it. Imagine a couple named Jason and Monica living in a 4-bedroom house in a suburb of Phoenix, Arizona, in early 2009. At the peak of the market in 2006, their home was appraised at $550,000. They had a mortgage of $400,000, giving them a healthy cushion of equity. However, by 2009, the housing market in Phoenix had cratered. Their home was now worth only $275,000. This is a situation known as being underwater or having negative equity. Jason and Monica owe the bank $125,000 more than the house is worth. Historical trends during the Great Recession show a fascinating dip in divorce filings that correlates almost perfectly with the rise in foreclosures. In a healthy economy, if Jason and Monica decide their marriage is over, the potential outcome is straightforward. They sell the house, pay off the mortgage, split the remaining $150,000 in equity, and use that cash to fund 2 separate lives. But in 2009, the math changed. If they divorce and sell the house, they don't walk away with cash. They walk away with a debt of $125,000 that must be paid to the bank just to close the sale. This created the phenomenon of the divorce-stalled couple. For Jason and Monica, the cost of separation was no longer just the legal fees. It was the literal bankruptcy of their future. Step by step, the economic reality of the 2008 crash forced thousands of American couples into a state of forced cohabitation. They were legally and emotionally finished with each other, but they were financially shackled to the same 30-year fixed-rate mortgage. Case studies from this period describe a rise in the separate but together lifestyle. Jason moves into the guest room or the finished basement. They create a schedule for the kitchen. They act as roommates who happen to share a last name and a massive liability. The data from the U.S. Census Bureau and the National Center for Health Statistics during this period is startling. While the divorce rate had been on a long-term gradual decline since its peak in the late 1970s, it took a sharp, statistically significant dive between 2007 and 2009. This wasn't because the stress of the recession brought people together. In fact, marital satisfaction surveys from those years show that domestic tension was at an all-time high. The problem was the liquidity trap. To move out, you need a security deposit for an apartment. In 2009, with unemployment hitting 10% and credit markets freezing up, getting a new lease or a new mortgage was nearly impossible for someone whose primary asset was in foreclosure. Now, let us bring this into the context of 2026. We are seeing a new version of this trap, which economists call the lock-in effect. Imagine a modern couple, Marcus and Elena, who bought their home in 2021 with a mortgage rate of 2.75%. Their monthly payment is affordable because of that historically low rate. But in 2026, the prevailing mortgage rates have stabilized at a much higher level, perhaps 7 or 8%. If Marcus and Elena divorce today, they have to sell that home and each find a new place to live. Even if they have equity, the cost of financing a new, smaller home at 2026 rates would likely be higher than their current payment for a large family house. The financial penalty for divorcing in 2026 isn't just about the loss of assets. It is about the loss of a low-cost lifestyle that can never be replaced. During the Great Recession, the U.S. government introduced various programs like the Home Affordable Refinance Program, or HARP, to help homeowners. However, these programs often had a side effect on marital stability. To qualify for certain types of mortgage relief or loan modifications, couples often had to prove they were living in the home as their primary residence. If one spouse moved out to begin the divorce process, they could potentially lose their eligibility for the very program that was keeping them from total financial ruin. This created a government-incentivized reason to stay in a broken marriage. We also have to consider the impact of the labor market. In the 1930s, the recession hit men's manufacturing jobs first. In 2008, it was a broad-based collapse, but the service sector and construction were hit particularly hard. When both members of a dual-income household are underemployed, the idea of maintaining two households is a mathematical impossibility. The Great Recession proved that the American family is often held together not by a marriage certificate, but by a joint tax return and a shared utility bill. But what happens when the economy finally begins to recover? This is where the historical data gets truly interesting. As the housing market began to thaw in 2011 and 2012, the United States saw what was dubbed the divorce surge. All those couples who were trapped in their guest rooms for 3 years finally saw their home values return to a level where they could break even or walk away with a small amount of cash. The backlog of failed marriages hit the court systems all at once. This suggests that recessions do not actually lower the long-term divorce rate. They simply act as a dam, holding back the inevitable flow of separations until the financial environment becomes hospitable again. This creates a high-stakes environment for children as well. Case studies from the 2008 to 2012 period suggest that children in these divorce-stalled households experienced a unique form of prolonged trauma. Instead of a clean break and a transition to two stable homes, they lived for years in a high-conflict environment where the parents were physically present, but emotionally absent or hostile. The economic recession, in this sense, didn't just affect the parents' wallets. It fundamentally altered the developmental environment of a generation of American youth. As we look at the potential outcomes of our current economic climate in 2026, we have to ask, are we building another dam? With the combination of high housing costs, student loan debt, and the rising cost of childcare, the barrier to exit for the average American marriage has never been higher. We are moving toward a society where only the very wealthy can afford the luxury of a mistake. For everyone else, marriage is increasingly becoming a permanent economic partnership, whether they want it to be or not. But there is one demographic that seems to defy all these trends. While the overall divorce rate was dipping during the Great Recession, one specific group saw their divorce rates actually double. This group wasn't affected by the housing crash in the same way, and their reasons for splitting have more to do with the long-term shift in the American lifespan than with the price of a gallon of milk. We are talking about the gray divorce revolution. Why are people over the age of 55 choosing to end their marriages in record numbers, even when the economy is at its worst? And how does the shift from Social Security to private retirement accounts change the way we age out of love? The next part of our masterclass will examine the shocking rise of the silver splitters, and how a lifetime of economic shifts culminates in the most expensive divorces in U.S. history. What happens when the recession hits your retirement instead of your mortgage? The answer will change everything you think you know about aging in America. The rise of the gray divorce represents one of the most significant sociological and economic shifts in the history of the American family. While the general divorce rate in the United States has been on a slow decline for decades, the rate for those over the age of 50 has done something truly unexpected. It has doubled since 1990. For those over 65, the rate has tripled. To understand why this demographic is defying the recessionary trends we have seen in younger generations, we must look at the structural change in how Americans fund their later years. Imagine a couple in the year 2026. Let us call them Robert and Diane. They are both 62 years old and have been married for 35 years. Their children are independent, and they are standing on the precipice of retirement. In the 1950s or even the 1970s, a couple like Robert and Diane would likely have stayed together regardless of their marital satisfaction. Why? Because their retirement was anchored by a defined benefit pension from Robert's employer and a Social Security check that was heavily weighted toward the primary breadwinner. The financial architecture of their lives was rigid. There was no easy way to bisect a monthly pension check that was tied to a single person's lifetime of service. But for Robert and Diane in 2026, the economic reality is entirely different. They are the 401k generation. Instead of a fixed pension, their wealth is held in a portfolio of private investment accounts, IRAs, and the equity in their primary residence. Unlike a traditional pension, these are liquid, divisible assets. In the eyes of a 2026 family court, a 401k is simply a pot of money that can be split down the middle using a legal instrument called a Qualified Domestic Relations Order, or QDRO. This tool allows the transfer of retirement funds from one spouse to another without triggering early withdrawal penalties or immediate tax liabilities. This liquidity has fundamentally lowered the barrier to exit for older Americans. Historical trends suggest that even during a recession, the gray divorce rate remains resilient. When the 2008 financial crisis hit, younger couples were trapped by their mortgages. But many older couples had already paid off their homes or had significantly more equity. Furthermore, the shift in life expectancy has changed the psychological math of the marriage contract. In 1930, if you were unhappy at 60, you might only have 5 or 10 years of life remaining. In 2026, a 60-year-old Diane can reasonably expect to live another 25 to 30 years. When faced with a quarter-century of life ahead, the economic cost of divorce is increasingly seen as a price worth paying for personal autonomy. However, the step-by-step details of a gray divorce during an economic downturn reveal a high-stakes gamble. Let us analyze the potential outcomes for Robert and Diane if they decide to split during a market correction in 2026. Suppose their combined retirement accounts are worth $1.5 million. In a booming market, splitting that $750,000 each seems like enough to maintain 2 separate households. But if a recession hit and their portfolio dropped by 30% just as they filed their paperwork, they are now looking at roughly $525,000 each. At age 35, a 30% loss is a setback. At age 62, it is a catastrophe because they have no time to wait for a market recovery. This leads to what economists call the retirement death spiral. To live separately, Robert and Diane must now pay for 2 roofs, 2 sets of utilities, 2 insurance policies, and 2 grocery bills. The economy of scale that allowed them to thrive on a fixed income vanishes. Research from the United States Government Accountability Office shows that women who divorce after age 50 see their standard of living drop by an average of 45%, while men experience a 21% decline. We also have to examine the hidden economic pillar of gray divorce, the 10-year rule for Social Security. In the United States, if a marriage lasts at least 10 years, a divorced spouse is entitled to claim Social Security benefits based on the other spouse's earnings record, provided they are not remarried. This creates a fascinating strategic window. Case studies of legal filings show a statistical clustering of divorces right after the 10-year anniversary. For someone like Diane, who may have spent years out of the workforce raising children, this rule provides a guaranteed social safety net that exists independently of the marital bond. It is an economic insurance policy that makes divorce viable, even when the private markets are failing. Then there is the issue of healthcare, which in 2026 remains one of the largest expenses for aging Americans. In a recession, a couple might stay together simply to keep one spouse on the other's employer-sponsored health insurance until they both reach Medicare eligibility at 65. If Robert and Diane divorce at 62, the cost of private health insurance for Diane could easily exceed $1,500 a month. This is the new marital anchor. It is not the house. It is the health insurance card. We are seeing a trend of legal separations, where couples stay technically married to maintain insurance benefits, while living entirely separate lives. Step by step, the gray divorce process also impacts the next generation. Unlike the 1930s, where the concern was feeding the children, 2026 divorces often impact the adult children and grandchildren. When Robert and Diane split their assets during a recession, the inheritance that would have provided a safety net for their children evaporates. The family home, often intended to be passed down, is sold to facilitate the split. This contributes to the broader trend of decreasing intergenerational wealth transfer in the United States, further tightening the economic squeeze on the middle class. The historical data from the 2008 to 2012 period showed that while gray divorcees were willing to split, they were also the most likely to experience repartnering quickly. But this repartnering is often not a second marriage. Instead, it is cohabitation. By 2026, the trend of older Americans living together without marrying has skyrocketed. This is a purely economic decision. By not remarrying, they protect their individual Social Security benefits, keep their separate estates clear for their respective children, and avoid the legal risk of having to split assets again if the second relationship fails. What this tells us is that the American recession has turned the later life marriage into a calculation of actuarial risk. The emotional companionate marriage of the 1950s has been replaced by a strategic partnership. If the partnership no longer provides a net gain in quality of life, and the legal tools like QDROs and the 10-year rule provide a viable exit, the recession's role is not to prevent the divorce, but to dictate the terms of the surrender. As we look at the broader economy of 2026, we see a generation of older Americans who are more financially independent than their ancestors but more vulnerable to market volatility. The gray divorce is a symptom of an economy that has individualized risk. When the collective safety net of the family is pulled apart, every person is left to face the headwinds of inflation and recession on their own. But if the older generation is focused on protecting their remaining assets, what about the younger generation? What about the millennials and Gen Z who are entering their prime marriage years, in an era of unprecedented student debt and gig economy instability? Their approach to divorce during a recession is fundamentally different from their parents. They are not just stalling their divorces, they are stalling their marriages. The next part of our masterclass will dive into the marriage strike and how the fear of a future recession is preventing the formation of the American family before it even begins. We will look at why the birth rate and the marriage rate are hitting historic lows in 2026, and what that means for the future of the U.S. economy. Is the declining divorce rate actually a sign of a dying institution? The answer lies in the data of the premarital recession. To understand why the divorce rate in the United States is hitting historic lows in 2026, we have to look at the gatekeepers of the American family, the younger generations who are choosing to opt out of the institution entirely. This is what economists and sociologists are calling the premarital recession. For decades, the narrative was that people got married to build a life together. Marriage was the foundation. You found a partner in your early 20s, you bought a starter home on a single or modest dual income, and you grew your assets as a unit. But in the current economic climate of 2026, the potential outcomes of this traditional path have shifted. Marriage is no longer seen as the foundation of adulthood. It has become the capstone. Imagine a couple in 2026 named Alex and Jordan. Alex is 30, and Jordan is 29. They have been in a committed relationship for 6 years. In any other era, the 1950s, the 1970s, or even the early 2000s, they would likely have been married for at least 3 of those years. But Alex and Jordan are looking at the ledger of a 2026 economy. Between them, they carry $115,000 in student loan debt. They live in a 2-bedroom apartment in a mid-tier U.S. city, where the rent consumes 35% of their take-home pay. They both work in the gig economy, or in mid-level service roles that offer limited long-term stability. For Alex and Jordan, the decision to not get married isn't about a lack of love. It is a calculated response to economic volatility. Historical trends show that during the Great Recession of 2008, marriage rates dipped significantly as people waited for the storm to pass. However, unlike the post-Depression era, the marriage rate never fully recovered. By 2026, we are seeing the result of a 20-year trend where the most economically vulnerable members of society, the ones most likely to face the stresses that lead to divorce, are simply staying out of the legal marriage pool. This creates a statistical illusion. When you look at the divorce rate in 2026 and see it falling, it doesn't necessarily mean that relationships are more stable. It means that the population of married people is becoming increasingly elite. Marriage in the United States is becoming a luxury good, accessible primarily to those with high levels of education and financial security. Because wealthy, educated couples have always had lower divorce rates, their dominance in the marriage pool makes the national divorce rate look lower than it actually is across the broader social spectrum. Let us look at the step-by-step details of the financial audit Alex and Jordan perform. First, they look at the cost of the wedding industrial complex. Even a modest American wedding in 2026 can easily cost $25,000 to $30,000. In a recessionary environment, spending that kind of capital on a single day is seen as a massive opportunity cost. That money could be a down payment on a house, or it could be a 6-month emergency fund in case of a layoff. By choosing to skip the wedding, they are essentially self-insuring against the potential outcomes of the next downturn. Second, they look at the legal and tax implications. While the United States tax code offers a marriage penalty or bonus depending on income levels, the real fear for Alex and Jordan is the legal merger of liabilities. In 2026, with consumer debt at an all-time high, getting married means tethering your credit score to someone else's financial history. If Jordan's industry collapses and they face a mountain of medical debt or a default, Alex's assets and credit could be seized or ruined by association. In a gig economy where the next paycheck is never a certainty, remaining legally separate is a form of risk management. This brings us to a historical parallel that most people overlook: the Long Depression of the 1870s. During that period of intense economic contraction, the United States saw a similar spike in the age of first marriage. Young men and women stayed in their parental homes longer, not because they wanted to, but because they could not afford the entry fee of a new household. In 2026, we see this repeated, but with the added complication of the modern debt-to-income ratio. We must also consider the role of cohabitation. In the 1930s, living together without being married was a social scandal. In 2026, it is the default. Case studies of cohabiting couples during the 2020 to 2022 pandemic recession revealed that these informal unions are much more fluid. When an economic shock hits, a cohabiting couple can separate with a fraction of the legal and financial friction of a married couple. They don't appear in the divorce statistics because they were never in the marriage statistics. This is the hidden turnover of the American family. Relationships are breaking up at rates that might be higher than in the 1970s, but because they are not legally sanctioned, they remain invisible to the official divorce data. The impact of this premarital recession on the U.S. economy is profound. The declining marriage rate is directly linked to the declining birth rate. In 2026, the United States is facing a demographic cliff. Fewer marriages mean fewer households being formed, which means less demand for new construction, appliances, and all the consumer goods that traditionally drive a post-recession recovery. The economic filtering of marriage is creating a two-tiered society: a stable, married, asset-owning upper class and a mobile, cohabiting, debt-burdened lower class. Step by step, we are seeing the death of the starter marriage. In the 1980s and 90s, it was common for people to marry young, realize they were incompatible, and divorce by 30. In 2026, that demographic is simply living together and breaking up without a court appearance. This means that the people who do decide to marry in 2026 are older, more established, and have already vetted their partners through years of cohabitation. They are, in effect, recession-proofing their marriages before they even sign the license. But what happens when this elite, stable group of married couples faces a crisis they can't budget for? What happens when the legal system itself changes the rules of the game mid-match? We have spent a lot of time looking at how the economy prevents divorce, but we haven't looked at the divorce economy itself. There is a multi-billion-dollar industry in the United States that relies on the dissolution of marriages. Lawyers, forensic accountants, real estate agents, and even specialized divorce coaches all have a vested interest in the process. During a recession, this industry has to adapt. When the clients have no money, the industry has to find new ways to extract value. We are about to look at the rise of litigation financing in divorce, a controversial practice where third-party investors fund a spouse's legal battle in exchange for a percentage of the final settlement. This turns a family tragedy into a high-stakes investment vehicle for Wall Street. How did the 2026 recession turn the American divorce court into a speculative market? And what does it mean for the average person when their private life becomes a line item in an investor's portfolio? To understand the future of the American family, we have to follow the money into the darkest corners of the legal system. The next part of our masterclass will reveal how the business of breaking up has become one of the most recession-proof sectors in the U.S. economy. What happens when your divorce is no longer just between you, your spouse, and the judge, but also includes a hedge fund? The answer will change the way you look at every prenup and postnup in the country. The intersection of high finance and the American family reached a surreal breaking point in 2026. As the economy tightened and traditional credit markets contracted, a new player stepped into the vacuum of the domestic courtroom: the litigation funder. This is the world of divorce financing, a sector that treats a failed marriage not as a tragedy, but as an asset class with a predictable internal rate of return. To understand why this matters for the average person, we have to look at the massive power imbalance that a recession creates within a household. Imagine a woman named Chloe in suburban Virginia. It is 2026, and the tech sector has just undergone another massive round of corrections. Her husband, James, is a senior executive at a software firm, whose compensation is heavily weighted in restricted stock units and performance bonuses. Chloe has spent the last decade managing their home and raising 3 children. When the marriage collapses, Chloe finds herself in a classic recessionary trap. James controls the liquid capital. He has moved the primary checking accounts, and because the credit markets are in a state of high alert, Chloe cannot simply walk into a bank and get a personal loan to hire a top-tier family law attorney. In previous decades, Chloe might have been forced to accept a predatory settlement just to survive the month. But in 2026, Chloe has a different option. She can apply for litigation funding. This is a step-by-step process that mirrors a corporate audit. A specialized firm, often backed by hedge fund capital, reviews the details of Chloe and James's marital estate. They look at the potential outcomes of the case, the value of the assets, and the likelihood of a high-value settlement. If they believe the case is a winner, they provide Chloe with the cash she needs for legal fees, forensic accountants, and even living expenses. The catch? In exchange for this liquidity during a recession, the funder takes a significant percentage of Chloe's final settlement, often with high interest rates attached. This historical trend marks the final evolution of the marriage contract into a financial derivative. During the 1930s, the barrier to divorce was the flat cost of the filing. In 2026, the barrier is the complexity of the assets. We are no longer just splitting a house and a car. We are splitting private equity stakes, unvested stock options, and volatile cryptocurrency portfolios. In a recession, valuing these assets is nearly impossible. James might claim his stock options are worthless because the market is down, while Chloe's forensic team argues they will be worth millions in a recovery. The litigation funder provides the war chest to fight that battle for years, effectively turning the divorce into a long-term investment. This has a profound impact on the divorce rate statistics. While lower-income couples are being forced to stay together because they cannot afford two rents, high-income couples are staying in the legal system longer. The average length of a high-asset divorce in the United States has stretched from 18 months in 2018 to nearly 36 months in 2026. Because these cases stay open, they don't count as completed divorces in the annual data, further masking the true level of marital dissolution in the country. The recession has essentially created a legal backlog, where only the most complex and well-funded cases are moving through the courts. Now, let us look at a different potential outcome of the 2026 recession: the rise of the recession-proof postnuptial agreement. Imagine a couple named Mark and Sarah. They have been married for 15 years and are currently facing the strain of a major downturn. Mark's small business is struggling, and Sarah is worried that if the business goes under, the creditors will come for their shared savings. In the 1980s, Sarah might have divorced Mark to protect her half of the assets before the bankruptcy hit. But in 2026, they choose a postnup. A postnuptial agreement is a contract signed after the marriage has already begun, often used during a recession as a form of financial firewall. Step by step, Mark and Sarah legally separate their assets while remaining married. They decide who owns the house, who is responsible for the business debt, and how assets will be split if they ever do divorce in the future. This allows them to stay together emotionally and domestically, while insulating Sarah's credit and savings from Mark's business risks. Historical trends show that the use of postnups in the U.S. spikes during periods of high market volatility. It is a way for couples to divorce their money without divorcing their partner. However, this creates a new kind of hollowed-out marriage. Case studies from the 2026 period indicate that these economically driven agreements often change the power dynamic of the relationship. When Sarah knows she is legally protected from Mark's failures, the shared risk that defined the 1950s marriage is gone. The relationship becomes a series of individual financial maneuvers. This is the true legacy of the modern recession. It forces us to view our partners as potential liabilities. We must also address the settlement squeeze caused by 2026 inflation. In previous recessions like 2008, inflation was low, meaning the dollar you received in a settlement held its value. In 2026, if a divorce takes 3 years to finalize, the purchasing power of the cash settlement might have dropped by 15 or 20%. This has led to a new trend in legal negotiations: the cost of living adjustment clause in alimony and child support. Lawyers are now fighting over inflation index payments, adding yet another layer of complexity to the process. This brings us back to the question: who is actually winning in the 2026 divorce economy? The historical data suggests it is not the families. It is the infrastructure surrounding the dissolution. We are seeing the birth of divorce real estate specialists, who only work with couples in foreclosure, and co-parenting app corporations that charge monthly fees to facilitate communication between hostile ex-spouses. During a recession, when most industries are contracting, the conflict industry, in the United States, is one of the few areas showing consistent growth. Step by step, The American recession has professionalized the breakup. We have moved from the 1930s model of desertion and abandonment to a 2026 model of asset protection and litigation financing. But as we look at the wreckage of these financial battles, we have to ask what happens to the social fabric. When marriage is treated as a merger and divorce as a liquidation, what is left of the family unit that is supposed to be the bedrock of the U.S. economy? The most chilling potential outcome is the credit score divorce. In 2026, as banks become more restrictive, your credit score is your most valuable asset. We are seeing case studies where couples divorce specifically to prevent one partner's medical debt or business failure from dragging down the other partner's score, purely so one of them can still qualify for a car loan or a rental agreement. This is divorce as a survival tactic, a way to keep one person clean in the eyes of the algorithm so the family as a whole can continue to function. But there is one final piece of the puzzle we haven't touched yet. As the legal and financial barriers to divorce become more complex, a new movement is growing in the shadows of the 2026 economy. It is a movement that rejects the luxury of legal divorce and the trap of legal marriage entirely. We are talking about the rise of the informal economy of the heart. Why are millions of Americans in 2026 choosing to live in non-legal family structures that the U.S. Census can't even track? And how does this underground family network provide a better safety net during a recession than the traditional marriage contract ever could? The answer will reveal the radical future of how we will live, love, and survive in the next decade of the American experiment. We are heading into the world of sovereign domesticity. The concept of sovereign domesticity in 2026 represents a radical departure from the traditional American marital contract. It is the emergence of a domestic lifestyle that exists entirely outside the reach of the family court system and the federal tax code. As the economic pressures of the mid-2020s have mounted, we are seeing a historical trend where the risks associated with legal marriage are viewed as too high for the potential outcomes they offer. In previous decades, the recession trapped people inside marriages. Today, the fear of the next recession is preventing the legal marriage from ever occurring, creating a shadow economy of the heart that operates on its own terms. Imagine a couple in 2026 named Tyler and Mia. They have lived together for 8 years. They share a mortgage on a townhouse in North Carolina, and they are raising 2 children. By every social metric, they are a family. However, Tyler and Mia have never signed a marriage license. This is not a lack of commitment. It is a strategic economic choice designed to maximize their domestic liquidity and minimize their exposure to the divorce economy. In a recessionary environment, Tyler and Mia look at the legal system and see a predator. They know that if they marry and then decide to part ways during a downturn, the state will step in and demand a significant portion of their remaining assets through court fees, mandatory mediation, and the forced liquidation of their home. By remaining legally single, Tyler and Mia are practicing sovereign domesticity. They have drafted private, non-marital contracts, often called cohabitation agreements, that dictate how they will split their assets if they separate. These contracts are governed by contract law, not family law, which means they are much faster and cheaper to resolve. In 2026, we see the rise of decentralized ledger technology being used to manage these private family agreements. Tyler and Mia use a shared digital vault where they track their individual contributions to the household. If the relationship ends, they don't need a judge to tell them who owns what. The data is already there, verified and immutable. This removes the conflict for profit motive that drives the traditional divorce industry during a recession. Step by step, the economic benefits of this informal arrangement are undeniable in the 2026 labor market. Consider the potential outcomes regarding student loans and income-driven repayment plans. In the United States, your marital status can significantly impact your monthly student loan payments. If Tyler and Mia were married, their combined household income would likely push their loan payments to a level they could not afford during a recession. By remaining single, they each qualify for lower payments based on their individual incomes. This is a survival tactic that the official divorce statistics completely ignore. It is a marriage strike driven by the math of debt. We must also look at the historical trends of the multigenerational household as a form of sovereign domesticity. During the Great Depression, people moved back in with their parents out of desperation. In 2026, we are seeing the rise of the mommune and the dad pod. These are non-traditional living arrangements where divorced or single parents pool their resources to weather the recession. Imagine a group of 3 single mothers who rent a large house together. They share the cost of the mortgage, utilities, and childcare. They operate as a single economic unit, but they have no legal ties to one another. This arrangement is highly resilient to economic shocks because it has multiple income streams and built-in redundancy for labor. The impact on the official data is a growing dark pool of domestic instability. When the U.S. Census Bureau looks at the divorce rate in 2026 and sees it declining, they are missing the fact that the turnover in these informal sovereign households is likely higher than in traditional marriages. Because there is no legal barrier to exit, these relationships can dissolve and reform with much higher frequency. This creates a more volatile environment for children, but it provides the parents with the extreme flexibility needed to survive a gig economy recession. If Mia loses her job in North Carolina and needs to move to Texas for work, she can do so without a custody battle or a court order, provided her private agreement with Tyler allows it. Case studies from the 2026 recession also reveal a trend of credit splitting among legally married couples who have no intention of divorcing. This is a fascinating inversion of the 1930s model. In 1932, a couple stayed together to share one credit line. In 2026, a couple might live apart and present themselves as separated to the bank so that only one person's credit is ruined by a business failure or a medical catastrophe. They are staying married for the health insurance and the tax benefits, but they are operating as separate economic entities to protect the family's total borrowing power. This is a sophisticated form of financial engineering that treats the marriage license as a tool rather than a vow. As we look at the step-by-step details of how these sovereign families handle healthcare, we see another shift. In the 1950s, the family plan was the gold standard. In 2026, with the fragmentation of the insurance market, many couples find it cheaper to get individual subsidies through the Affordable Care Act as single people than to pay for a high-premium family plan through an employer. The recession has made every $100 of monthly cash flow a matter of life and death. When the government makes it more expensive to be a legal family, the American public responds by becoming an informal family. However, there is a dark side to this movement. Sovereign domesticity offers flexibility, but it lacks the statutory protections that took a century to build. If Tyler decides to walk away from Mia and their children in 2026, Mia does not have the same immediate access to the temporary alimony or automatic stay on assets that a married woman would have. She is reliant on the strength of her private contract and the speed of the civil court system, which is often slower than the family court. During a recession, when everyone is desperate, the lack of a legal safety net can turn a flexible arrangement into a predatory one. We are seeing a rise in domestic contract litigation, where the battles are just as fierce as divorce court, but are fought under the rules of business law. This leads us to the most significant shift in the 2026 economy, the financialization of the breakup. We are now seeing the emergence of relationship insurance. These are private insurance products where a couple pays a monthly premium while they are together. If they separate, the insurance pays out a lump sum to cover the cost of moving and setting up two households. This is the ultimate proof that the American people no longer view the government or the legal system as the guarantor of their domestic stability. They are turning to the private market to ensure against the failure of their own hearts. What does this mean for the future of the United States? It means we are moving toward a society where the family is no longer a fixed legal unit, but a fluid economic alliance. The recessions of the past taught us that the state can be a prison for the unhappy. The recession of 2026 is teaching us that the state is a luxury we can no longer afford. We are building a new way of living that is faster, leaner, and more resilient, but it is also more isolated and transactional. But as we transition into this world of sovereign domesticity, a new question arises. If we have successfully de-risked the marriage, have we also destroyed the wealth-building engine of the family? Historically, married couples have accumulated significantly more wealth than single people or cohabitors. By avoiding the risk of divorce, are we also avoiding the primary mechanism for middle-class prosperity in America? And what happens when the first generation of sovereign families reaches retirement age with no shared assets and no legal standing? The final part of our masterclass will pull all these threads together. We are going to look at the marital map of 2030 and project the long-term potential outcomes of this century-long evolution. We will reveal the one hidden data point that predicts with 90% accuracy whether a marriage will survive the next 5 years, regardless of the economy. And finally, we will answer the most important question of all. Is the American family actually dying, or is it just evolving into something we don't recognize yet? The conclusion to our deep dive into the history of divorce and the economy is about to reveal the blueprint for the next 100 years of American life. We have arrived at the final frontier of the American marital landscape, a point where historical trends and current economic data converge to reveal a startling reality for the year 2026 and beyond. As we have seen, the relationship between divorce and the economy has undergone a total inversion over the last century. In the 1930s, you stayed married because you were poor. In the 2020s, you stay married because you are wealthy. This phenomenon is known as the Great Divergence, and it is the most critical factor in predicting the potential outcomes of any household during a recession. To understand the blueprint for the next 100 years, we must first look at the case study of a hypothetical couple in 2030. Let us call them Caleb and Sarah. They are part of the new marital elite. Both are highly educated. Both have stable careers in the high-growth sectors of biotechnology and renewable energy, and both entered the marriage after the age of 30. For Caleb and Sarah, the 2026 recession was not a threat to their union. It was a period of consolidation. Because they possess what sociologists call high marital social capital, they were able to use the downturn to refinance their investments and tighten their household budget without the risk of insolvency. This brings us to the hidden data point that predicts marital stability with nearly 90% accuracy, regardless of whether the stock market is crashing or soaring. It is not the amount of money in the bank, nor is it the intensity of the romance. It is the combination of the age at first marriage and the educational parity between the partners. Historical trends show that for every year a couple waits to marry past the age of 25, the likelihood of divorce drops significantly. In 2026, the average age of first marriage in the United States has hit an all-time high of 32 for men and 30 for women. This delay acts as a natural recession-proofing mechanism. By the time these couples marry, they have already survived the volatility of their 20s as independent economic actors. Step by step, we can see how this maturity premium changes the divorce calculus. When a recession hits, an older, more established couple like Caleb and Sarah has a deeper reservoir of life experience to draw upon. They have seen market cycles before. They have developed the communication skills necessary to navigate financial stress without resorting to litigation. Contrast this with the potential outcomes for a couple who married at 21 with high school diplomas. For them, a 10% jump in the price of groceries is not a budgeting challenge. It is a marital crisis. The data suggests that we are moving toward a marital map of 2030 where geography and class are the primary indicators of domestic stability. In high cost of living hubs like San Francisco, New York, and Austin, the divorce rate will continue to plummet toward levels not seen since the 1950s. This is the luxury marriage. These unions are protected by high incomes, prenuptial agreements, and the lock-in effect of low-interest real estate. In these enclaves, marriage is a wealth-building engine that compounds over decades. However, in the vast stretches of the American interior, we will see the continued rise of sovereign domesticity. Because the legal and financial cost of entry for a traditional marriage has become too high, millions of Americans will continue to live in informal, fluid family structures. This is the most significant takeaway from our 100-year look. The United States is no longer a single culture of marriage and divorce. It has split into two entirely different economic ecosystems. One system uses marriage as a fortress against recession. The other views marriage as a trap that increases vulnerability to it. As we look at the potential outcomes for the next decade, we must also address the role of technology in the divorce economy. By 2030, the use of relationship insurance and automated mediation will be standard for the middle class. We are seeing the rise of smart contracts that automatically adjust child support based on real-time inflation data and employment status. This professionalization of the breakup will continue to make the divorce rate look lower on paper, as more people settle their disputes through private, algorithmic channels rather than public courtrooms. The 1930s saw the rise of the poor man's divorce through desertion. The 2030s will see the rise of the professional's divorce through digital liquidation. We also have to consider the long-term impact on intergenerational wealth. One of the primary drivers of the wealth gap in the United States is the stability of the parental home. Children of the marital elite in 2026 will inherit the compounded assets of two stable, high-earning parents. Children in the sovereign domesticity tier will face a more fragmented inheritance. This means that the recession of 2026 isn't just a temporary dip in the GDP. It is a permanent structural shift in how wealth is passed down to the next generation of Americans. So, is the American family dying? The historical trends suggest the answer is a definitive no. It is simply evolving. The necessity marriage of the 1930s was about survival. The companionate marriage of the 1950s was about social conformity. The individualistic marriage of the 1970s was about self-actualization. And the marriage of 2026 is about economic resilience. We have moved from a society that values the vow to a society that values the portfolio. If you are looking at your own relationship through the lens of the current economy, the lesson of the last century is clear. Financial literacy is as important as emotional intelligence. The couples who survive the next recession will be those who treat their union not just as a romantic bond, but as a strategic alliance. They will be the ones who understand the mechanics of the two-income trap, the lock-in effect of debt, and the value of the maturity premium. We have traced the path from the breadlines of the Great Depression to the high-stakes litigation funding of 2026. We have seen how housing bubbles, interest rate hikes, and labor market shifts have all left their mark on the American bedroom. The story of divorce in the United States is ultimately the story of the American dream itself. A dream that is increasingly expensive, highly regulated, and deeply tied to the fluctuations of the global market. As we move forward into the late 2020s, the question for every American couple is no longer just whether they love each other. The question is whether they have built a structure that can withstand the weight of a changing world. The blueprint for the next 100 years is already being written in the bank statements and legal contracts of households across the country. We are witnessing the birth of a new kind of family, one that is leaner, more calculated, and more aware of its own economic value than ever before. But as the traditional marriage becomes an elite institution, what happens to the social safety net for everyone else? When the family unit is no longer the primary provider of stability for the working class, who or what will fill that void? The answer might lie in a new form of community-based economics that is already beginning to emerge in the shadow of the 2026 recession. While the divorce rates for the elite continue to fall, a new kind of social contract is forming among those who have been left out of the marriage market. We are entering the era of the collective household, and the data suggests it might be the most disruptive force in the U.S. economy since the Industrial Revolution. What happens when the American dream of the white picket fence is replaced by the reality of the digital commune? Our next investigation will dive into the rise of the collective and how it is redefining the very concept of home in America.